Alright, good morning everybody. It's BSI Vector here, and today we're going to talk about Trading Price Action Trends chapters 21 and 22. If I can ever figure out how the slide goes forward. Okay, just gonna click on it. These are my references slides, just give you a second to look. Again, if you're in the Robot Trading Discord, you have all these slides via link or download, whichever one you prefer. Moving on. So chapter 21 is about spike and channel trends. I find these to be the most common. And I think Alec talks about how it's the most common type of trend as well. And a spike and channel is really just at least one trend bar that creates a gap. Usually they're formed in the first hour, but you can see in my examples that they can be formed really at any time. But they, in my opinion, are the best when they're formed in the first hour, and they tend to create the strongest trends. And when they are strong, they form a basis for the measured move, which I will see in my example. Most of the time they are hit. The pullback bar could be one bar or a dozen. Sometimes they even go as low as testing that spike bar low, actually. If the pullback is generally one or two bars, the trend tends to be stronger than a deeper pullback. Sometimes if you get a deep pullback, but the gap stays open, you might be getting into trading range behavior. And the trend, you tend to resume in the form of a channel. Oftentimes they're micro channels, but all the channel trading rules apply, which we talked about in these previous videos. So make sure that if you are trading a channel that you're buy low, sell high. Typically I would like to play with the channel trend. So if it's a bull channel, I'd like to be long below bars, but always expect the channel to break out the opposite way. So if it's a bull channel, expect it to break out to bearish, and vice versa, forward bears. So these are just some examples. As you can see, they're actually the same chart. I just had the right one zoomed in a little bit more because it was a little bit harder to see in a 5 minute. But you have a spike bar 28, and then immediately we get a pullback bar 29. Reasonable to buy the spike. It looks like it's a high one buy, bar 30. So after the follow through, you get a channel. After the spike, you get a channel after bar 29. So it says 31 or 37. It should be 30 to 37. And you can see the measured move, and how you measure, according to Al, is the low or open of the bar to the high or close of the bar. Pretty much what he's saying is you measure the body. So if you take the body here, you can see on bar 33 specifically, when we hit that measured move target, there was profit taking there, and that was some of that upper wick. And then on the right, it's just bars 41 through 49 here, but it's the same concept, right? Although I kind of messed up my measured move a little bit on the top. I should have brought it down like a little bit, but it doesn't really matter. The measured move is still hit, and you have a spike bar 41 with a pullback bar 42, and then you get a channel follow through. It's a tiny channel, just a 3-bar micro channel, but it's still there, so I wanted to include it just to have a bearish example as well. And then I included this example just to show you that channels can last much longer than expected. This was actually Monday, I believe that was November 13th, I want to say, if I'm not being crazy. And technically, when you measure the spike, it's all the bodies of the candle, but you stop measuring at the first pullback bar, right? Well, you don't get a pullback bar until bar 8 here, which is crazy. So this is like a pretty large spike, right? But you can still take a measured move of the low of this candle to the height of this candle, include the entire spike. And guess what? Maybe not today, but the bulls who bought that first bar pullback, they were rewarded on Tuesday with, looks like about 20 points. So it still works. But again, this example was just to show you like this stuff can go on for longer than it seems like. And they even get a little channel. They try to break out to the upside, but again, channel rules apply. Breakouts to the upside in a bullet channel typically do not work, and they're low probability. And the bears, get a spike, pullback, and they start to channel as well. But it was just too much bullishness in the morning to really do much for the bears. Plus, there's a lot of double bottoms here, lower low. Yeah, just it's a little too much buying pressure. So eventually, the bulls were rewarded. So chapter 22 is about trending trading range days. Oftentimes, you'll get these when the opening range is very small. So typically, at least for this past week, the opening range has been around 15 points in ES. So if you get about half of that, like 8 to 7 points, maybe a little bit less, then you can kind of expect a trending trading range day. You'll usually get a breakout within the first hour, and then the market goes and forms immediately like another trading range, within about 30 minutes. And that trading range will sometimes go back to test the extreme of the previous trading range, and then whatever prevailing side will hold that back test, or every now and then you'll get a trading range day that reverses and it becomes actually a reversal day. But that's not very common. So this example on the left, you have a 7-point range in the ES open, and you can reasonably expect it to double. And the range that I'm using is the first 30 minutes. So these are 5-minute candles. Take the low of the first 30 minutes with the high of the first 30 minutes. To me, that's the range. And then you have a breakout bar, 7, and a pullback bar, and it's actually a spike pullback in channel, funny enough, but it turns into a trading range day, a trending trading range day, and you get your measured move as well. Because the range doubles, you expect it to double, and there you go. We ended up doubling. So, and on this one, this was actually, I believe, Wednesday of this week. The bulls, in their first 30 minutes, they end up getting a breakout to the upside, but the breakout creates another trading range. And this example is actually where the day ended up becoming a reversal day. So clearly we're in a range for the first 10 bars, right? Not just the first 30 minutes, but really the first 10 bars. And then you have a breakout bar 11, a backtest bar 12, and then backtest held bar 13. Excuse me, reasonable long. 13 is not the best buy signal in the world, but it's reasonable still. And the only problem here is that what ended up happening was the bulls weren't strong enough to continue the trend, and instead they created a trading range. Trading ranges tend to become 50-50, although there's always a little bit higher of a probability that the prevailing side will break out to the upside. But regardless, the bears ended up getting some selling momentum from bar 18, 2-bar pullback, and then crushed. So they were able to close bars within the previous trading range, which is good for the bears. And they created another trading range here, funny enough. And then they broke out once more. And then the words of wisdom from Al, I didn't really have much that stuck out to me. But yeah, I will be uploading another day of live trading, either later today or tomorrow. So just be on the lookout for that. I'll see you guys later.